All right. Good afternoon, Simpler family. Hope y'all are doing great on this Friday. Yeah, good to see you, Marco. Always a pleasure to be in here with you on Fridays doing a quick 30-minute teaching session. And today I'm going to talk about how I have been able to not get wicked out on trades only to watch price go in the direction I had originally anticipated. There's nothing worse, in my opinion, than getting stopped out of a trade that you have taken on a dramatic wick only to watch price then recover and make it to your targets. That is very frustrating and was very frustrating to me until I started learning from Trendy John. He is a supply and demand trader here at Simpler in the Trendy Trading Room, and he taught me how not to be wicked out of those trades. Now, before I talk about how we do that, I need to first mention the importance of allocation and the amount of money that you allocate per trade because if you are over allocating in your trades and trading a risk amount that you're not comfortable with, or that your overall account balance cannot handle the amount that you're allocating to each one of your trades, um, that is detrimental to your account, your psychology, and a lot of other important factors. So, risk is the most important part in trading, and finding an allocation amount that you are truly comfortable with, allowing you to trade the levels on your charts and not your emotions connected to your P&L is super important. Okay, so if you haven't found a way to figure out that allocation amount, I invite you to join us in the Trendy Room where we talk about that virtually every single day. All right. So let me just first start off by saying that if you've been struggling in the market the month of February, you're not alone. Okay. It has not been an easy month to trade. And historically, looking back, it is not an easy month for me to trade. I am very, very happy to say, though, that this being the last day of February, I can confidently say that for the first time since I began trading options over 6 years ago, this February, I'm going to end the month with some nice profits, even better profits than what I had in January. So I am very proud of that. And if you're not a member of the Trendy Trading Room, the good news is we have a webinar coming up on Wednesday where you can meet Trendy John and we will talk a little bit about trading supply and demand in 2025. We will share with you our P&L graphs and just show you some trade examples that we've been trading. And then we have a class coming up on March 8th where we're going to teach you supply and demand trading. So if you are interested in seeing how John and I have both been profitable for the month of February trading supply and demand, mark it on your calendar, register for our upcoming webinar on Wednesday of next week. And then, of course, get your spot reserved for the class up on the 8th of March. All right, all of that behind us now. I want to show you a couple of trade examples that has been traded in the trendy room, right? These are shared alerts. All of our alerts are trades. All of our trades in our trendy accounts come through to the room automatically through API alerts within milliseconds of when we execute the trades. And we are also very good about letting you know what trades we're looking at, giving you the levels and the plans for that trade before price ever gets there. That's important. And supply and demand allows us to know exactly where we want to get in, where we are wrong on the trade, as well as where we want to take our profits. So I pulled up a chart of Boston Scientific here, BSX. This was an alerted trade in the trendy room, and it was a chart that our members had the levels ahead of time. But what we're talking about today is how not to get stopped out on a nasty wick that looks like this, right? So if I had a stop, a hard stop right here at $99.75, which is how I used to trade, you can clearly see I would have been stopped out on this trade. So I would have entered the trade here at 101.01 and my stop 99.75 on this huge wick, I would have been stopped out. Does everyone see that? I just want to make sure you're following me and you understand the verbiage. All right, so this is the wick that would have stopped me out before I began trading supply and demand. Now, this wick did not stop me out because I commit to this demand zone and I commit to the daily candle close. Now, this candle could have closed all the way down here, and then I would have been stopped out. And you might say, yeah, but look at how much more your loss would have been. And that is accurate. My loss would have been greater, right? All the way down here at $97 compared to 99.75. But what I did whenever I first started trading supply and demand is I kept a running log of how often committing to a candle close was beneficial to my P&L and by how much, and how many times that it was detrimental to my account and by how much extra, right, I would have lost. And I can report that it over 80% of the time, it was in my favor to commit to a candle close on the time frame chart that I was trading the demand or supply zone out of. So, with the example of BSX, you can see we entered this trade. We were not stopped out on this ugly looking wick. We stayed in the trade, we trimmed the trade, and now we're out of the trade. We could have actually re entered here at the demand zone, but this wasn't a plan that I had set out ahead of time. But you can see yesterday uh, was back in demand and today opened right there at demand. The important thing is I want to show you how by committing to this candle close, I was not stopped out and rather able to take profits and it was a winner. All right. Another example of this is Walmart. So Walmart dropped on earnings. I believe it was earnings that caused the drop. I don't really pay attention to the catalyst that brings price into supply or demand. I'm more concerned with identifying demand levels ahead of time, making sure trendy members know where those levels are and where I'm going to be executing trades. And then I consider executing, or I don't consider, I execute at demand. So here's an example of Walmart, and this was a great winner, and it happened fairly quickly. You can see on the daily chart here. We got into this trade. We went long as price came into the demand zone. Okay. Again, this trade was given to the members way before price got there. We already knew that we had demand down here at 94.23 by 92.35. It was a bullish name. And I knew I wanted to enter Walmart, a trade in Walmart to the upside from demand. So the plan was given ahead of time. Then the trade was executed, which was alerted within seconds of when I got in the trade and when I got out of the trade. All of that. Okay. But notice the next day after we got in this trade, we have a wick here below my stop. Again, $92.35. Actually, on this day right here, had I stopped out of all of my positions that had a wick below my stops, my account would have been down about 7.5%. But by committing to the candle closes and not getting stopped out on wicks, my account is up almost almost 20% for the month of February. So, really, really good stuff here. Here's another example. It wicked below my stop of 92.35, but I was not stopped out because the candle closed above my stop. Then we made it to the target, the first target here. And I actually closed out of the runner here as price dropped down below the bull channel. But that would be another lesson, maybe another week here for us. But happy to report that this trade paid about $300 per contract, simply buying in a demand zone and then exiting here at first target. All right, let's do a more recent example. And this is actually a trade that I started today. It was originally started as a what we call a PMZ trade, so a day trade, but it's looking like it's going to become a swing trade. And the reason I say that is we got to stop here at 235.30 and price has not made it to my first target, right? So here we are. So this could definitely indeed become a swing trade into next week. So here's my stop, 235.30. That nasty looking wick, I'm ignoring because the candle closed above my stop. All right. Now, if I get a candle that closes below my stop, then I'll stop out and I will take the loss. It's not a big deal to me because I'm properly allocated in the trade. All right. So, the important thing for me is that I allow candles to close as long as my, in this case, demand zone continues to work. All right. So, yeah, if I make it to target up here, I move to a break even stop, and then this stop is no longer in play at all. And I wait for the next target, or I stop out at break even. Now, Todd asks, how do you know it's not going to gap down to the previous demand zone intraday? I I never know for sure, right, Todd? Um, that's where that first 10 minutes of my talk came in to play. It is, are you okay with the allocation amount that you are putting at risk in the trade, right? And are you following the rules with discipline? And then give yourself 30 days, 30 trades, et cetera, where you're journaling those trades and assess if the strategy is working for you or if you should look at a different strategy. You're speaking, I believe, of day trading. So maybe, it works better for you to look at the strategies around supply and demand trading for swing trading. But we never know for sure. That's why risk is the most important factor in all of this. All right. Anyone have any other questions about how to stay in a trade without getting wicked out unnecessarily? BK Man asks, how are the targets defined? Can you please walk through in Apple trade? How are these different between day trade and swing trades? So we use candle structure to identify supply and demand, BK Man. Again, you can come to that webinar on Wednesday, this coming Wednesday, to learn more about that. But we use candle structure. And how are they different from day trade versus swing trade? Basically, it's the amount of time that you're looking back on a chart. So if I were looking for a swing trade in Apple, right? I'm going to look at the higher time frame charts, like a daily chart, a weekly chart. Believe it or not, I even trade quarterly charts, and those are for my long term leaps or equity trades. So, for example, here on Apple, I would be interested in taking a leap or an equity trade down here at 212 by 200, where I would start a position and then add to it at 174 by 159.78. It's the amount of time on the chart. And then if I'm just trading, for instance, a 4-hour chart on JPM, for instance, then if I'm trading this 4-hour chart, I'm anticipating the trade to last for 1 week. So I would look at where the demand is at and where supply is at and plan on being in the trade for a week. I would probably buy out 2 weeks to expiration just to have a little extra time there. But this is your demand zone on a 4-hour chart for JPM. So a trade that I would be trading, say, March 7th to March 21st, some expiration there. I could use this demand zone to go long JPM. And then I already know where my target is because it's at supply. All right. And we do this day in and day out. Todd asks, what time to the close do you wait to manage your stop? I assume you're talking about swing trades. So, for instance, a swing trade for Apple. All right. Sorry, Toss is running slow, guys. So I have to uh, go to or it takes a little longer for the chart to load up. So if Apple becomes a swing trade for me today, towards the end of the day, this off of a 4-hour chart, this zone is right here. This demand zone's right here. Remember, I'm not paying attention to that nasty looking wick. It looks suspect to me anyway, but notice it did come into a daily demand zone, and that's where you got that big old pop. But when will I consider this a loser? If I'm trading it off of a 4-hour chart, this on toss, your 4-hour candles don't close until an hour after the market closes. So it gets a little tricky off of a 4-hour chart, but you just have to use your best judgment. Typically, I will just come in about 30 minutes before the market is closing, right? And I will examine this 4-hour chart. And if it looks like we're making lower lows inside of the demand zone, or the market overall is not in demand but has farther that it could fall, meaning the ES, then I would just go ahead and cut the trade about 30 minutes before the end of the day. But if the overall market, which is the S&P 500 is what I use, if it's in a demand zone and I'm anticipating, right, that we could see a rally on the following day, then I might be more lenient and go ahead and stay in the trade as long as I'm okay with the risk. No harm, no foul, right? Because this candle technically does not close until I can no longer get out of the option trade, being 5 p.m. Eastern time is when this candle will close. But I I do consider the overall market sentiment and where it is at the time. Right now, I can tell you that ES futures, the S&P 500, has dropped down into a demand zone where I anticipate buyers will be stepping in. This 4-hour zone here until today, it was a fresh zone, and you can see, hold on one second. And you can see that there was a nice, powerful move out of this zone. All of those factors lead me to err on the side of being more aggressive and staying in the trade. On into over the weekend and into Monday before making a decision. Now, if Monday morning I stay in this trade and Monday morning we wake up and price is down here, then if it doesn't recover by 1 o'clock when that candle is going to close, then I will go ahead and exit the trade for a loss. But I do commit to those candle closes. All right. All right. And these are great questions. Thank you so much for participating. Anybody else have any questions about how not to get wicked out of your trades? Let's talk a little about a, scalp trading perspective. And I'll use SPY because, a lot of people like to scalp trade. So it is the same exact idea. You're working off of a 5-minute candle and you are trading. In this case, it would be a zone, right? So you're in demand, but we're only planning on scalping. The market is um, down headed to the downside, all right? And it's inside demand. But now you can and we do scalp trade to the downside inside of this demand zone. I would not put on a swing trade to the downside if price was in a higher time frame demand zone. I never do that. But for scalp trading, here's a little example that I'll use that I would be committing to a 5 minute candle close, or if you like 2 minute candles, you can commit to a 2 minute candle close. So for me to scalp trade to the downside on SPY right now or ES futures, you pick your poison, right? That trigger would be here at measuring this down move, the 236, which is the bear channel. It is also coming in confluence with the EMA cloud, which, because price is below it, is resistance, right? And I would set my stop as the 382. If price gets above the bear channel, I would be stopped out. So on a 5 minute candle, I'm looking at this and I can see that my stop would be about 80 cents, 86 cents, it looks like here. I would be committed to these 5 minute candles. So I could get a wick above 584.68, but I'm not going to stop out because I'm counting on this bear channel to remain as the resistance level. And I'm anticipating that price will come down again. This would be my target. I'm anticipating that price would come back down here to 582.76. So I would stay in this scalp type trade as long as I do not have a 5 minute candle close above 584.68. BK man asked, did you put Fibonacci bands with yesterday's close? I didn't, not if I'm just talking about a day trade type scalp trade right here. I wouldn't use yesterday's close. So this is originally, I'll show you. Originally, I had fibs drawn from this down move up to the high. And but when the golden fib broke, then my fibs flip. So then I'm going to go from where this down move began, the most recent down move began, and that's where I'm going to run my fibs, right? Okay. And that's how I would play it. And again, this is a valid scalp type trade to the downside for me. And this is my stop. So as long as the candles close below 584.68, I stay in this downside trade. For me, that is buying at the money puts. So I would have been buying the 583 puts here, and I'm in as long as 584.68 doesn't have a candle close above it, or we make it back down to target here at 582.76 and even further, depending on how many contracts I buy. See, all of these big wicks right here, there is nothing the market likes to do more than hit your stops with these big wicks, stop you out, and then continue the move. And I know that's very frustrating. It was very frustrating for me. And that's why I'm so passionate about teaching what I learned from Trendy John. And of course, in the Trendy Room, Trendy John teaches it as well. But it's where our passion lies, is really in the education piece. So again, if you're not a part of the Trendy Room, join us for the webinar. Join us for in the room. Become a part of our Trendy family, and I believe that you will be very happy with the amount of time we spend with you educating and helping you to become a more consistent and profitable trader. All right, guys, y'all have a great weekend, and I will talk to you next week. Much love.